Good afternoon and welcome to Canadian Ag Markets. My name is Brian. It is a rainy, snowy, blowy, and cold day out there in Western Canada. So, before we get into what's happening in markets, let's take a look at what's happening out there because there is a really big mix of things happening here in Western Canada. Some snow where we have a lot of our consulting clients in the eastern part of Alberta through Saskatoon and down into Brandon. Here in Winnipeg, we are getting kind of this mix of snow and ice and rain, but we have heard reports as well that Swift Current is just a mess today as it was raining, froze pretty good. The roads are covered in ice. So, stay safe out there, everybody. We don't need any any accidents or bad things happening. So let's talk about what's happening in markets today. Canola was down. Oh, just to start off here, you might notice that some of the oil seeds and such we have moved from the January reference contract to the March reference contract. That's just because there is more volume now and more open interest in some of those contracts. So versus yesterday, we were reporting on the prices in the January futures contract. Today, we've moved to the March on the oil seeds and some of the other markets as well. So canola was down $2.80 on the market today at 608 and a half or 850. Minneapolis wheat was down 3 cents to 562. Kansas was up 2 3/4 to 507 3/4. Chicago was down 3 1/4 to 506.25. We're going to talk about the spread relationship between those two winter wheat classes here in this video. Soybeans down 3 to 1068 3/4. Corn down or up 4 to 440 and a half. Soybean oil was up 14 points to 49.05. Canadian dollar was down 19 points to 72.52. Cattle was up $1.15. Live cattle was up $1.15 to 229.55. Feeders were up $1.28 to 336.33. All right, just before we get into some of these charts, I found this article on farms.com, which I thought was interesting. There's some doing research projects in the University of Saskatchewan that could or have found a new processing that could boost protein and oil profits. I think that's a good thing anytime that we can get more margin into the crush. That does tend to translate into better prices for farmers. So from what I understand, the canola seed contains kind of a tightly bound outer hull and an inner kernel. So in the conventional processing, the processing that we do now, the entire seed is crushed to extract the oil, which leaves behind a meal that includes both the hull and protein. So this byproduct is typically used as low-grade cattle feed or fish food, or is in some cases discarded. So the processing, this new processing process would remove the hull from the kernel before crushing, and would create additional high-value products beyond the oil. So I thought that was interesting. I am a advocate for adding value domestically whenever we can here for our agriculture industry. So I thought I would just point that out. I think it's interesting. It also stated in the article that it could be done using conventional crush methods, so it wouldn't need to retool crush plants significantly. So we'll see if that takes hold. Let's look at March canola though today. It did make a new low today, did settle lower today at 608 and a half. So we still are on the March lower. That March support is around $600. We still have that support based on the November at 597. But here we are just above $600. I think 600 could be a bit of a psychological support level, but it depends, I think, on the correlated markets like soybean oil and soybeans, et cetera, to see if that's going to hold. If those markets are going to continue to fall, I don't think canola will be able to sustain support if we see larger losses in some of those other oil seeds and vegetable oils. I did want to kind of point out the yield curve on canola. You can see here it's pretty even and pretty straight up. This is indicative of a bearish market at this point in time. And here is the spreads that we are seeing right now if put into dollars per ton. So almost $12 a ton going to the March from the current January, and then almost another 12 going to the May, and then almost about 9 or 10 going to the July. So these are still very strong carries. Again, that signals a market that is bearish, and there obviously is opportunity to sell the forward contracts instead of having to take the spot price at the time and give up all of those spreads, uh, which is generally a smart thing to do if the market is trending lower, is to hedge. And if you take the higher price on the board, that gives you some cushion as well. But we are going to compare that, or we're going to talk a little bit about what's happening in the cash markets as well. So here is basis for canola for the January delivery period. It has been rising. It may not feel like it necessarily because the cash price has been declining, or we're seeing lower values overall in the cash price. But if you separate out the futures and the basis, this is the best basis that we've seen for quite some time for this delivery period. Anyway, we hit the harvest lows, of course, at the beginning of October, where they were closer to 55, 57 under. Again, these are posted bids, not necessarily with premiums or anything. We're close to the highest level. So what's kind of, what's driving that? What's happening? Is there some element of harvest pressure? The harvest pressure has gone away now into the Christmas season. Yes, there is some of that, but what also is happening is what we call convergence to cash. So what's happening now, or as we move towards the January contract, is those holding short positions in futures contracts, do they have to decide whether they want to make physical delivery rather than offsetting the contract in the market. Now, there is an incentive right now to do that because of the wide basis contract. So if you are a long holder of futures, and you are part of the clearinghouse, or you have the ability to make delivery, rather than taking the futures price minus the basis, which is still pretty large, 40, 45 under, depending on where you are, maybe even larger, you can deliver to the specified delivery locations and you don't have to be subjected to that basis at all. So for those holding long positions, this is mostly commercials and things like that. But instead of flushing the physical into the market at this time, you can deliver your long position, and take the higher cash price. So what that creates in the marketplace is what we call convergence to cash. Now, here's kind of a way to look at it. In this particular case, this is where we have the spot price rising and the futures price rising. What we're kind of seeing is the opposite right now. The futures price is moving lower, but the basis price, as we mentioned, was moving higher. So the difference there between the futures and the cash price is converging, so that once we get to the January contract period, or once we get to the first notice delivery day, which is near the end of December here, those two prices, the cash price and the futures price, should converge. At this point, both two things are happening at the same time. The futures are moving lower, the basis is moving higher, and that creates that convergence to cash. So hopefully that little tidbit was educational for you. Let's move into some of the correlated products here. Now, February crude oil saw large losses yesterday. We were touting in yesterday's video that there was a correlation between crude oil, soybean oil, canola, and all of those type of commodities. That correlation doesn't seem to be as strong today. We saw February crude oil rise in value. It didn't make up for all of the losses that we saw yesterday, but it did make an uptick. What did soybean oil do? It didn't really continue to drop, but it was essentially unchanged from the close yesterday. It did make new lows earlier in the day, earlier this morning. So still weaker overall, but neutral on the day. So we didn't see the gains in soybean oil that, comparatively to the losses that we saw in soybean oil yesterday as a result of crude oil. Again, correlation doesn't always mean causation. But it was interesting to see just how much that can change just even in a day. Here's the Minneapolis wheat contract. We're kind of switching gears here to wheat a little bit. It did make a new low today. We talked in our video yesterday about how it was holding support here at about 565. It now moved below that to about 561, closed at 562. So we are now below the harvest lows. And if we pull that out into a longer term, this is a year of history, you can see that we're definitely in fresh new low territory. So technically, or from technical traders, this would be a continued bearish sign. Although Minneapolis wheat isn't necessarily one that would be heavily used for speculation. Chicago might be a little bit more used for that. Again, here's the 1 year view. You can see that we are testing some support right now, right around that 520 area. We do have something in the 515 area here from the mid October lows. So Kansas still holding on to support at this point, and Chicago is also breaking to new lows as well today. Here's another 1 year chart showing Chicago. It did make some new lows, broke down below support. Again, that's not necessarily a good thing. We have some 20-day crossing happening here, but crossing first the 100 and then the 50. Again, that's a little bit of a negative signal overall. But one thing that's happening that's really interesting, we've talked about this a couple of times in our videos, is that Kansas was trading at a discount to Chicago for the longest time through much of August, September, October. Recently, it has been rallying back, and we now have Kansas wheat trading at a premium to Chicago again. Um, I don't know if that means that that will continue, but it's encouraging to say the least. Even though the markets continue to decline, which doesn't feel good. At least it may feel good that the higher quality, higher protein is now trading at least close to even from what we were before. So it kind of evens out some of that quality distinction there. It might continue, particularly if we see some demand for wheat coming out of the U.S. Or even the Black Sea. Some of the conflict in the Black Sea may also be affecting this, as largely the stuff coming out of the Black Sea is 12 and a half protein, which would be in direct competition to the Kansas wheat contract. So if there's less of that available to the market, it raises its value, particularly relative to Chicago. So we may be seeing that as a market play as well. Here's March soybeans. It came down to test the 200-day moving average today. We have seen significant losses through the first half of December here, and even starting at the end of November. We've almost got to the point where we've erased all of the gains that we're seeing leading up to the Trump and Xi meeting at the end of October. So the optimism has definitely moved out of the market. That is despite the fact that China continues to buy soybeans from the US. This was reported this morning, 198,000 tons of soybeans for delivery to China during this crop year. There was also another 125 for delivery to unknown for this marketing year as well. This 198, is about 3 Panamax vessels. 125 is about 2 smaller pannies. So, about 5 Panamax vessels total were reported yesterday, at least that were over the reporting period, or the reporting threshold. So we are seeing continued purchases by China, but I think the market is still disappointed that the original claims by the administration were that there would be 12 million by the end of the calendar year, and that has now been pushed out into the end of the crop year, which would be the end of August. So pretty big difference there. Corn had a pretty good day today. It is still kind of more on the neutral side, holding support at 435. Again, we're talking about the March here. There's a lot of kind of trade in between this 435 and 450. Corn has had some really good export data, which is kind of causing the market to feel that corn exports are outperforming the USDA's estimate, even as of last or earlier in the month here. So the corn exports to the US are currently estimated to be 81.3 million tons from the U.S. This is a really large number over the last part of history. So, and I believe that the market is kind of pricing in a little bit better exports out of the U.S. as well. So that's kind of holding corn up, and it's one of the better stories that we're seeing in the markets at the moment. I did want to talk a little bit about the Canadian dollar here, because we mentioned it yesterday, how it was testing that double top that happened in August and September. It did touch that almost perfectly, and it is now correcting a little bit. It's conceivable that this could correct down to the 20-day or 200-day moving average right now, which is just sitting above 72. So that, in overall, that we in grain marketing terms, we think that's positive. It does have a positive effect. A lower Canadian dollar has a positive effect on wheat basis, soy basis, and canola futures as well. If you're not subscribed to this channel, please do so by clicking the subscribe button below. We'd love to have you here. We want to continue to grow this channel. But that's it. that's it for Wednesday. Again, stay safe and watch out for that weather.